Thanks very much, George, and good morning, everybody. It's always good to be back in Miami. I see some familiar faces, but plenty of new ones too. For those of you who don't know me or don't know Capital Economics, we're one of the world's largest macroeconomic consultancies. We have clients right across the globe, about 1,500 in total, offices right across the globe. I'm based in New York. And we have lots of clients in Latin America too. I was just saying, I've just come back from Sao Paulo, and it's good to see things down there finally starting to turn around as well. What I'm going to do today is give you a brief run through of the economic outlook in Latin America. I'll touch on what the latest data are telling us about the recovery in the region. I'm going to talk a bit about what's been behind that turnaround in growth and whether it can last. And I'll talk a bit about what investors we think should watch for over the next 6 to 12 months. And for your benefit, and indeed for mine, all of this presentation will be in English. I'm not going to subject you to my Spanish or indeed Portuguese. Right, so where are we on the latest on the economic recovery? Well, this chart, I think, gets to the heart of it. The blue line here is our own proprietary indicator, our GDP tracker of the region's growth. It uses real-time, low-profile data. It gives us a real-time measure of economic growth. The black line there is the official GDP data that we've aggregated from national sources. And you can see there's a pretty strong V-shaped recovery in the region. So that's the good news. The region is now growing at about 2% a year. That's the fastest rate of expansion we've seen since early 2014. So there's clear signs that the region has turned a corner in terms of the economic recovery. And what's more, that recovery has been increasingly widespread. This chart shows you economic growth in year-on-year terms. In the first quarter of this year, the blue bar. The second quarter of this year is the grey bar. And you can see it's improving in pretty much every economy, with the exception of Mexico. And even there, actually, in Q-on-Q terms, economic growth has been pretty stable over the first half of this year. So what's behind this turnaround? Well, I think there are three broad things that we can point to. The first, and perhaps the most obvious, is that global commodity prices have both stabilized and then more recently started to recover. The black line on here is the aggregate measure, the S&P GSCI measure of global commodity prices. That's plotted on the left-hand side of this chart. The blue bars are Latin America's commodity exports. And you can see that the recovery that we've seen in global commodity prices over the past year or so would imply a gradual improvement in the region's exports. And I've marked on our forecast for what we think is going to happen to global commodity prices over on the right-hand side. And we expect to see a steady improvement over the course of this year and next too. The second thing I think that's helped has been weaker currencies. Now, this is always a slightly odd thing to present to clients. They're used to the idea that weak currencies are a bad idea, and certainly if you're holding assets denominated in local currency, the last thing you want is the currency to weaken. Well, if you're a macroeconomy and you've just experienced a huge terms of trade shock in the form of lower commodity prices, actually a weaker currency is exactly what you do want. They make your exports more competitive. They raise the local currency value of any dollar-denominated revenue stream that you have. They help to repair the public finances and so on and so forth. And what we've seen across the region over the past 3 or 4 years has been the gradual depreciation of currencies from a point, I think, where currencies were overvalued. They were starting to squeeze manufactured exports. Indeed, we've seen industrial sectors in the likes of Colombia, Brazil, really not going anywhere for the best part of a decade. Currencies are now much weaker. You can see that in this chart. And I think that's helping to restore external competitiveness. And we've started to see a turnaround in industrial sectors in the region as a result. The third thing I think that we can point to as signs of improvement and behind this recovery is the gradual and steady return of confidence, both consumer confidence, but I'd argue actually perhaps more importantly, business confidence. This chart shows you a weighted average of investment in the region, that's the black bar, and business confidence in the region, which is the black line, and business confidence, which is the blue line. This takes an aggregate measure for Brazil, Mexico, Colombia, and Chile. We don't get decent data on Peru, so I've excluded it in this instance. And you can see that confidence has started to return, it's improving, and that is consistent with a steady improvement in fixed investment in the region too. So there you have it, 3 things that have been behind the recovery, I think. The return of confidence, weaker currencies, and the stabilization of global commodity prices, and indeed the improvement in recent months too. That's not to say that there haven't been headwinds, and I think there still are headwinds, and there are things that are going to keep this recovery weaker than in previous recoveries, I think. One of those is dealing with the legacy of private debt that was built up in the boom years. This chart shows you what's been happening to private credit growth across a range of different economies in the region, Chile, Peru, Brazil, and Colombia. You can see that in each case, we've seen a really sharp slowdown in credit growth. Indeed, in the case of Brazil, it's now negative in year-on-year terms. That reflects the deleveraging in the private sector that was almost inevitable as a result of the huge run-up in private debt that we had in the boom years. That, I think, has a bit further to go. It's always difficult to benchmark these things, but if past forms are anything to go by, typically it takes between 2 to 4 years for this deleveraging to play out. So I think we're still in the early stages of this, particularly when it comes to Brazil. And that's going to weigh on, it's not going to prevent the recovery from happening, but it's going to certainly keep it weaker than in previous recoveries. And there are some issues on public sector balance sheets too. Not widespread issues. This chart shows public sector budget deficits across the region. I've marked on our forecast for this year and indeed for 2018 in the black and the grey bars. Not really an issue for us to worry about when it comes to Colombia, Mexico, Chile, Peru, but it certainly is an issue in Brazil. I'm sure you all know about that, but also I think increasingly Argentina as well. There's lots of optimism around President Macri's economic agenda, and I think for good and sensible reasons. But I think the public sector balance sheet is one potential weak spot in Argentina's economy, and I'll come on to talk about that later. So, economic recovery driven by these 3 broad things, but there's some balance sheet risks lingering in the background that I don't think will derail the recovery, but will certainly keep it weaker than in previous economic recoveries in the region. I'm going to talk a bit more about what's happening in some of the region's major economies in a bit more detail now. I'll start with Brazil. Now, the place to start, of course, is what's happening in politics, as is often the case in emerging markets. The economics is really following the politics in a lot of these countries. I'm not going to summarize, I'm not going to go into detail on Brazil's role in political crisis, not least because it changes from day to day, but I think this chart kind of summarizes the key points. The headlines is that President Temer is clinging on. There's certainly going to be more charges coming against him, but he has the backing of Congress. I think it's difficult to really foresee that he's going to be leaving office at any time before the end of his term, which ends in October 2018. What I do think is going to happen, though, is that this political crisis is going to frustrate any major reforms, particularly things that need the changing of constitutions, so particularly the pension reforms. Labour market reforms, tax reforms, I think they can all still happen, but I think we should brace ourselves for perhaps some disappointment when it comes to pension reforms, and that's important in the context of those fiscal deficits that I talked about earlier. Now, the disappointment in pension reforms is a medium-term fiscal issue. That means that the budget deficit is going to remain large, and I think that's going to perhaps cast a long shadow over the bond market over the coming years. What it doesn't mean, though, is that any kind of slippage on these pension reforms, I don't think is going to have a major impact on the economic outlook in the near term. I think there's often some misunderstanding here. I would put far more emphasis on actually what's happening in terms of financial conditions. The really key point here is that when we saw the political crisis in 2016, when Dilma was removed from office, that was accompanied by a huge tightening in financial conditions across Brazil. This chart tries to get at this. It's our proprietary measure of financial conditions. It takes account of things like credit spreads, credit lending, bank lending, exchange rates, the equity market, bond yields, and so on and so forth. You can see that huge tightening. Anything that goes up is a tightening of financial conditions. Huge tightening when Dilma was ousted in 2016. Absolutely no move whatsoever following the corruption allegations against Temer. Indeed, financial conditions have been loosening. And I think that helps to explain why the economy essentially, despite the worst predictions of most of Wall Street, dare I say it, has actually shrugged off this political crisis, and things have continued to improve. One reason for that, I think, is that the inflation picture is radically different. Inflation's been falling. The lagged effects of the weaker currency have dropped out of the inflation picture. The food spike, the spike in food prices that pushed up inflation last year started to unwind. Inflation is now running at an 18-year low in Brazil. And it's not going to stay that low forever. Indeed, I suspect it's going to start to creep up over the coming months. But it's going to remain well below the central bank's target range. That means further interest rate cuts. That means bond yields have perhaps a bit further to fall in local currency terms too. And that is going to continue to support the economic recovery. So while I have perhaps harbour some concerns about the medium-term outlook for Brazil, by which I mean the 3 to 5 year horizon, I actually think that in the near term, the economy is going to surprise us on the upside. I think the consensus is way too gloomy on the prospects for the next 6 to 12 months. And I wouldn't be surprised if we see economic growth surprising consensus forecasts. What about in Argentina? Well, there's obviously been a huge boom in financial markets in Argentina over the past year. Lots of optimism around President Macri's agenda. And you can see that in this chart. This shows the huge inflow of portfolio flows to Argentina, in US dollar terms, 4-quarter sum. I've marked on there the arrow. When the peso was devalued, capital controls were lifted. Huge influx of portfolio capital to Argentina. So lots of optimism in the markets, and I think indeed that started to translate into the real economy. Initially, after Macri's election, we saw a recession. I think that was inevitable, given the extent of the balance sheet adjustment that needed to happen, particularly as regulated prices were increased. But more recently, we've started to see a turnaround. This chart shows our GDP tracker, again in black, against the official GDP numbers in blue, year-on-year terms. And you can see the economy might be growing as much as 5% year-on-year. Which for Argentina would be extremely good. But, and there's always a but, I think there's a few things that we need to keep our eyes on. Few seeds, potentially, of the next crisis being sown here. The budget deficit in Argentina, I touched on that earlier, remains uncomfortably large. Dollar debts, just as importantly, particularly in the sovereign space, have risen sharply over the past year. And I think this is where this starts to interplay with something else that's happening. Inflation remains relatively high, about 25% year on year. That high inflation makes the peso a one-way bet for depreciation. And what's the one thing you don't want when you have lots of dollar debts? A weaker currency. So all of this could potentially be a toxic combination. I don't expect it's going to derail the recovery in Argentina over the next year or so, but a failure to get a grip on inflation, a failure to bring in the budget deficit, could potentially sow the seeds of the next crisis in Argentina a few years down the line. What about the third large economy in Latin America, Mexico? Well, the good news, I guess, is that all those predictions about the impending collapse of Mexico's economy following the election of President Trump in November have been proved to be misplaced. This chart shows just how wrong the business sentiment surveys got it. The blue line here shows the weighted average of the IMEF manufacturing, non-manufacturing surveys in Mexico. These are business surveys, essentially. Survey companies go out and ask businesses, how do you think the economy is going to be going? And there's normally a pretty good relationship between GDP and what these surveys say. They fell off a cliff in November. Lots of pessimism. But actually, you can see that if you plot that against the GDP line, the black line, normally a pretty good relationship. This time around, that relationship broke down. So widespread pessimism that didn't translate into any form of meaningful downturn in Mexico's economy. Actually, the economy's been pretty resilient. Now, that's partly, I think, because the protectionist threat, I think, is slightly misunderstood. Part of it was because Trump's protectionist rhetoric was mainly an election tool. It was always going to be far more difficult for him to get anything translated into policy action while in office. It was never likely that exports from Mexico to the US were going to collapse overnight. And indeed, the political realities mean that all those election campaigns, promises to pull out of NAFTA on day one, actually that's been rowed back to renegotiation. And those renegotiations, as things stand, seem more likely to produce tweaks to the current arrangements rather than wholesale changes. So we're looking at things like changes to rules of origin, courts of arbitration, and so on and so forth. One further cause for optimism, I think, is that we've seen growing signs that corporate America is likely to push back against bigger reforms. And indeed, agricultural America will push back against big changes too. And that, of course, is important because a lot of that happens in the Midwest, which is, of course, the part of the country that pushed Trump to victory. My one concern here, though, is with the timetable. The timetable, I think, is overly ambitious. The idea here is that both Trump and both Mexico think they're going to get a deal, and indeed Canada think they're going to get a deal done at some point in the next six months or so. That has never, ever happened when it comes to trade negotiations. These things take a long time. And the issue here is that we've got Mexico elections in the middle of next year. We've got congressional midterms at the end of next year in the US. I think the key risk here is that any slippage against what, to me, seems to be an overly ambitious timetable ultimately causes frustrations that result in more extreme outcomes, particularly some form of backlash from the US administration. We already know that President Trump supposedly signed the executive order to pull out of NAFTA during his first 100 days when there was no signs of any quick wins on healthcare. He needs quick wins to appease the base. The US economy itself is looking like it's in a relatively mature stage of the recovery. I think the US starts to slow the second half of President Trump's term. And when that starts to happen, that's when I think these protectionist risks might start to crystallize. For now, though, Mexico's economy, I think the key message is that it's been relatively more resilient than people had expected, and I suspect that continues for the next year or so. Right, I'm going to wrap up quickly, and I'll leave some time at the end for Q&A. I just want to touch on one final thing, which is that we have a busy political calendar ahead. We were discussing this earlier. Elections due, congressional elections in Argentina next month. Presidential elections in Chile in November. The key things to watch here, the rise to the left in Chile. Piñera, I think a Piñera victory, centre-right victory, is priced into financial markets. Huge run-up in the stock market in Chile over the past 6 months or so. Any sign of a left-leaning coalition, I think, would quite quickly result in sharp falls in financial markets in Chile. And then, of course, the performance of Macri's coalition in Argentina. I've touched on some of those fundamental balance sheet tensions in Argentina. The optimist case is that he's waiting for these congressional elections to get out of the way, give himself a bigger mandate, and then he'll get on to some of the really tough stuff. If his performance in congressional elections next month is disappointing, then I think it becomes much more difficult to get some of those things done. And it doesn't stop there. Once we get into next year, in 2018, we have presidential elections in Colombia, in Mexico, in Brazil, and the stakes are high in each of these countries, but I think they're particularly acute in Brazil. That big budget deficit, the big need for structural reforms, particularly constitutional changes that allow things like pension reforms of the pension system to take place. Huge, huge challenge there. And I think one of the things lingering in the back of my mind is that we've seen this populist insurgence, both in the US, both in Europe. I'm from the UK, we've seen Brexit. Now, has the recession in Brazil, huge recession, biggest recession in recorded history, has that created the space for a populist insurgence? I think it's too soon to say whether it has or not, but I think it's certainly something that investors should have one eye on. Right, quick wrap up. Here's our GDP forecasts for the coming year in 2018 and 2019. We expect the recovery to continue is the short point. Above consensus forecasts in some countries, particularly in Brazil there, 1% growth this year, 2.8% next year. That's well above what most people are expecting. But the key message here is that I think that this recovery is going to prove relatively durable. It's going to be weaker than in previous cycles, but I think the recovery itself proves to be relatively durable. So, conclusions. Latest data suggests that the economic recovery is picking up pace, and I suspect that continues over the coming year or so. Consensus seems to be a bit gloomy in a couple of places. But there is certainly plenty of things that could go wrong over the medium term, and I would certainly encourage everybody to keep a very close eye on political developments over the next 6 months or so. The stakes are particularly high. Well, they're high everywhere, but they're particularly high in Brazil and in Argentina. With that, I'll wrap up. I think I have about 5 minutes for Q&A. There's a question here at the front.
Just maybe when we go back to the outlook for the region generally, and you're talking Thank you. Just in terms of talking about outlook for the region generally, and what I would express as volatility in this busy political calendar of events from an elections perspective, do you run downside scenarios and think about where foreign investment would rather place their bets? Can they withhold for a year and wait for outcomes to happen before going back in, or are they vested in the economies to keep their investments going, kind of thing?
Yeah, I think it really depends on from country to country, and indeed investment type to investment type. I'm generally pretty skeptical of any kind of simulations that say if X happens in the political space, then Y happens to financial markets and indeed to the real economy. We've seen they've been proved wrong time and time again. To take one example, Brexit. That was supposed to derail the UK economy, lead to a collapse in UK financial markets. Actually, the FTSEs that have been hit record highs and the UK economy has been relatively resilient. Analysts were equally wrong in their simulations about what a Trump victory would mean for US financial markets. So I wouldn't put too much stock in various simulations. I think what we can do, though, is start to look from country to country and try to pick out these slightly idiosyncratic risks. So, I mean, one obvious one that could go wrong is when you have lots of short-term capital as opposed to long-term investment. So if you've got lots of big foreign direct investment flows, it's quite difficult to pull those out overnight. If you're invested in a copper mine in Chile, then the chances are that you're in there for the long game, and you just have to kind of ride any regulatory or tax changes that come, be it huge upfront costs and very long payoffs. If, on the other hand, you've pumped loads of money into the Argentine stock market on the hope that these massive reforms are going to deliver economic turnaround and actually the political landscape starts to shift, then I think that can change quite quickly. So I'd be very wary when it comes to political risks of countries that have seen huge inflows of short-term capital. Argentina is the obvious one. There's been a lot of short-term capital going into Brazil as well more recently. They're the things that can evaporate quite quickly. Long-term investment, foreign direct investment, I think tends to be far more sticky. Any other questions? One question down here at the front.
Thank you. Beyond what is a short to medium term, largely cyclical recovery in the region, can you comment a bit about the longer term drivers of growth? I mean, what's the region's structural competitive position globally? Don't know if you can touch on that. What's the demographic situation of these countries? Just to give a sense, not what just happens in the next 18 to 24 to 36 months, but a bit beyond that, as long-term investors would be.
Yeah, it's a really good question, and I think it's something that, as economists and indeed financial market participants, often we get too hung up on what's going to happen in the next year without really thinking about the big picture. I think if we take a step back, I'm relatively optimistic on from a cyclical standpoint. I'm relatively pessimistic from a structural perspective, not just in Latin America, actually, on emerging markets more generally. If we take a step back, we're used to the idea, after 15 years of very strong growth from 2000 to 2015, that emerging markets tend to converge. Incomes in emerging markets tend to catch up with those in developed markets. They're poor, they can import capital and technology, they experience rapid catch-up growth. Actually, the lessons of history suggest that doesn't tend to happen. The 2000s were an anomaly in that regard. In the 1980s, emerging markets didn't catch up. In the 1990s, they didn't catch up. The same was true in the 1970s, if you look across the board. Indeed, we've got data going all the way back to the 1950s, and the 2000s were the only era in which incomes in the emerging markets as a whole caught up with those in the developed world. And if you take a step back and think about why that happened, I think it's pretty obvious, really, that we saw this wave of liberalization across different emerging market regions. So we saw the collapse of communism in the post-Soviet bloc. We saw, of course, liberalization in Latin America, restoration of democracy, finally getting a better grip on public finances. Hyperinflation came down, currencies were liberalized, tariffs came down, integration into the global economy. And then, of course, in Asia, the opening up of China. Very investment-intensive model, too, which pulled in lots of commodity exports, and that led to this self-reinforcing cycle whereby the commodity-producing half of emerging markets benefited from China's integration into the global economy. The net result was massive increase in productivity growth in emerging markets and in Latin America, and massive economic growth too. I think demographics in this, by the way, are a bit of a sideshow. That doesn't really tend to explain very much. It's all about productivity. If you fast forward to now, though, I think all of those things were essentially one-offs. You can only liberalize once. You can only cut trade tariffs once. You can only get a grip of hyperinflation once. You can only liberalize your exchange rate once. You can only integrate China into the global economy once. It's all happened now. And if we look at what's been happening to trends in productivity growth across emerging markets, we saw this big jump in productivity and economic growth in the 2000s, and it's now started to slow, and I think that's a structural slowdown that will persist. So I think the short answer to your question is I think we need to get used to rates of growth in Latin America that are about 2 to 3% a year, rather than this idea that we're going to go back to 5 or 6% a year. And that, I think, is something that we've not quite got our heads around as economists, analysts, investment advisors, investors, and so on. Now, is that a disaster? I don't think it necessarily is, particularly when you consider that potential growth in the US economy is now perhaps as low as 1.5%. In Europe, it's as low as 1%. In Japan, well, Japan would be very happy for 1% growth over a 10-year cycle. So I think Latin America continues to outperform developed markets. There's still that catch-up, but the rate of catch-up is much slower, and the rate of economic growth is much slower. And I think the sectors that deliver that growth are going to be very different as well. Huge consumer-driven growth in the 2000s. I think this time around, the cycle has to be more about investment, infrastructure, those type of things. That tends to be the recipe for success in emerging markets. So one question towards the back.
Yeah, you mentioned the risk of frustration for the pension reform in Brazil. I would like to know what are the risks that impacts the economy, and how.
So, yeah, I mean, it's a good question. This is something that's obviously fixated markets. What's happening to pension reforms in Brazil? Now, the reason these are important, the context here is that big budget deficit that I showed you earlier, about 9% of GDP. Most of that blowout in the budget deficit, well, some of it can be explained by a collapse in revenues as the economy slowed, but most of it is about spending increases. And indeed, about a third of, we've done some work on this, about a third of the increase in government spending since 2013 has been on pensions, which is crazy when you think about the demographic profile of Brazil, still a relatively young country. So the pension system is unsustainable. It needs reform, but the problem is that in order to reform it, you need to change the constitution. And in order to change the constitution, you need 2/3 majority in both houses of Congress. So there's the challenge. The issue is if you don't, Temer has this on his agenda, the reforms he proposed are actually only ever going to be a first step. They'll need to do more. The next government is going to need to do more if it wants to bring the pension system under control. The question is, what happens if these reforms get diluted? And I think they will. My base case is that at the moment, the reforms save about 1.5% of GDP a year over a 10-year period. I suspect that gets watered down to somewhere below 1. And bear in mind that at the moment, the deficits are on the pension system are about 4% of GDP. So this only gets some way. What happens to the real economy if there's frustration on those reforms? Well, what really matters, I think, is how that translates into financial markets. I mentioned earlier that the way we try to think about the way the political crisis and the slippage on these reforms is affecting the real economy is through our financial conditions indicator. If I think there are signs that there's slippage on these pension reforms, but something will get done, and by the way, by the time this starts to happen at the start of next year, perhaps there's signs that we're going to get perhaps a more market-friendly candidate emerging from the PSDB that actually has a chance of winning the election in 2018. So there might be some continuity there. Then I think markets will probably take that in their stride. If, on the other hand, there's slippage on pension reform and the idea that we're going to get this market-friendly centrist emerge in the elections at the end of next year is actually misplaced, there are actually growing signs of this kind of leftist populist insurgency, or indeed right-wing populist insurgency in some cases, and there's going to be no more pension reform on the agenda, then I think we get a very different story. We'll start to see a widening credit spreads, the currency will sell off, the stock market will tank, and we'll see that start to then affect the real economy. So really what the key thing to focus on here, I think, is A, there will be some slippage. B, what's the political landscape looking like in 2018 elections? If that's favourable, then actually the markets take that in their stride. If it's not, then I think the markets sell off, and only at that point do I think it really starts to affect the real economy. I think we're out of time, so thank you all very much for listening to me. We now have a panel discussion, of which I'm going to participate, but hopefully not say very much, because it's on something that's way out of my area of expertise.